Hello, everybody, and welcome to today's My Game Show, Kirsty Ames show, but My Game Show. So in a minute, we are going to start talking about MBOs. I know everyone's very excited, but before that happens, it's been a big week. So if anybody has managed to get to the pub, please let us know in the comments, because I haven't yet, and I want to know if it's as good as I dreamed it would be. So today I am joined by the magnificently suave, sophisticated, debonair Mike Ames. How you doing, Mike?
I thought you were going to say Carl Swansbury there. Yeah, I'm absolutely fabulous. 5 a.m. I've got a client in Australia, and so I've already done 7.5 hours work today. Actually, I was up at 5, getting ready for this 5:30. They like 5:30 meetings, which apparently is 2:30 in Queensland or wherever the heck they are. So I'm okay. I had some caffeine. I think I should be fine.
That's good.
Now, we're joined today we're going to talk about this. So we're joined by Carl Swansbury, who actually, Carl is the head of corporate finance for Rycroft Glenton, and also has the honour, perhaps he wouldn't see it like that, of having sold my last recruitment firm to Harvey Nash. Did a great job as well. So it's not the Carl Swansbury show, in case you thought about it. I'm just saying he did a good job, right? Okay. So for what it's worth, and we're going to talk about MBOs today, aren't we, Kirsty?
We are indeed. So, I mean, obviously Carl's the expert here, but I know quite a lot about MBOs. So I know it stands for management buyout.
Indeed.
Maybe you know a bit more.
I don't want to take a lot of Carl's thunder. So what we'll do, we'll just jump into Carl. So, I mean, I obviously know what it is, but if I weren't to understand what an MBO was, what is it? In layman's terms, what is an MBO?
Sure, indeed, Kirsty, and great to see everyone this afternoon. So a management buyout, Kirsty, as you said, is a transaction where an incumbent team from within a business who are employed by said business actually club together to acquire the business from the current shareholders.
Okay.
So, and that is a viable exit for a business owner, is it not?
Indeed, absolutely, Mike. So when shareholders are considering their options when it comes to selling their business, of course, one option is a sale of the business to a trade acquirer. Another is to sell the business to the incumbent management team who currently run the business.
Now, some years ago, certainly when I sold my first business in the 90s, and perhaps we didn't look at it again in 2017, but certainly some years ago, an MBO was considered a sort of poor relation as an exit. So if you wanted the big bickies, the really big bickies, you floated, but not everyone could do that. So it's a trade sale. That's what everyone went for, and that's what I went for. But now that's not the case, is it? I mean, MBOs are a viable and reasonable way to exit a business, aren't they?
Absolutely right, Mike. I think that when you are, as a shareholder, considering your options, you've got a lot of things to think about. So, clearly you're thinking about value. You're thinking about when you get that value. So what deal structure is going to be appropriate. And of course, you're having to think about things like legacy. Because, of course, selling a business to a trade acquirer often might mean that acquirer will integrate your business and maybe rebrand it, make some structural changes. There could be headcount reduction. Whereas in a management buyout, because the business remains independent and privately owned, then actually the legacy is a different one you leave behind. But in answer to your direct question, Mike, absolutely, because of liquidity, because of the private equity interest in the staffing sector, definitely MBOs now are a very, very viable exit route for a shareholder, and often can deliver the same, if not more value than you can achieve from a trade sale, which is often not what one thinks.
Wow, no, I didn't think that at all. I always thought you got less, actually, but that's not the case at all.
Not necessarily. Obviously, we'll talk in a little while about why a trade exit can deliver more value for a shareholder. But we shouldn't assume for a minute that an MBO is less so likely to deliver full value versus a trade sale, because that is not necessarily the case.
So why would you choose an MBO then? What if you're a business owner now? People will be watching this. Business owners thinking, I've never really thought about it before, but that could be the way forward for me. Why would they choose an MBO over any other type of exit?
Sure, great question, Mike. So there's a number of different things to think about. So just to maybe highlight some of the most pertinent. So I guess first of all, if you as the shareholder or as one of the shareholders of your business are considering selling the business, then of course if you were to think about a management buyout, and of course that's only possible if you have a management team who are capable of running the business, which we'll come to shortly. But selling your business to the management team not only means you have a buyer who you can look toward, and you don't therefore have to market your business for sale to third parties. But of course, it definitely also means that you will be able to manage the sale process in a very covert, confidential way, because it doesn't require you to have to approach competitors / third parties who you might feel a little bit anxious in doing so. Similarly, it will give the people who you've nurtured and developed the opportunity to take ownership. It will give you the ability to leave legacy. Of course, the business will remain independent, so it will not be integrated into a large PLC environment. And of course, buyers often do look to integrate, whether it's a rebrand, systems, processes, procedures. An MBO will mean the business will continue to be independent and privately owned. I think another thing that's often very important to owner managers who are looking to sell a business is actually the ability to not only continue to have a degree of involvement in the business they've sold, but actually they might want to continue to retain a minority shareholding, which is possible in an MBO far more so than if a business is a PLC, who will naturally want any exiting shareholder to fully de-risk and exit.
Yeah, I mean, even for non-PLC trade sales, normally they want to buy everything, don't they? They want to buy all the shares. They don't really want.
Yeah, a strategic acquirer of size might definitely will want to buy 100% of a business, and that's because they'll want to do something with the business they've bought. Whereas if there's a minority shareholder hanging around, they'll want minority shareholder protections, which will preclude the buyer from doing certain things.
Okay, now I know Kirsty's got some questions, but two things before I do that. First of all, because of the confidential nature of this subject, if you've got questions but you'd rather not have your name associated with those questions, just send me an email. Put your questions to mike.ames@flair.co.uk. They'll come up on this screen here, and I'll keep looking over there every now and again, and I shall ask them anonymously. So that's absolutely fine. So please feel free to do that. And then I've just got one other question. If you're not going out to market, how do you know the value of the business that you can ask the management team to cough up for? Because if you go out to the market tells you, doesn't it, what it's worth really. But if you're not doing that, if you're not going out to market, if you're saying that MBO is the way we're going, how do you know what value to put on your business?
Yeah, great question, Mike. And of course, you need to know the value of a business before you can consider how you should extract the value. So I guess there's two things you can do. You can either engage a corporate finance advisor like me to actually give you an understanding as to how your business will be valued. Because of course, as you know, Mike, we've got a significant amount of experience having bought and sold dozens of businesses across a range of sectors, including recruitment. Secondly, you can actually look at listed businesses in the sector and look at what their price earnings multiple or PE multiple is. Granted, large listed businesses will always have a higher PE multiple than a privately owned business of smaller size would attract. But nonetheless, it might give you at least a good indication as to likely valuation. But the truth is, Mike, the easiest way to establish market value without going to market is to speak to corporate finance advisors who will give you a really good handle as to the current value of your business.
So just again, sorry, Kirst, I know you're dying to get in because you've got a load of questions, but one last on the back of this. Is it viable to have an MBO as part of your exit strategy and also be looking at a trade sale? So effectively say to the management team, hey, look, I'm going to get out now. I'm going to look for a trade sale. But if you guys want to put some sort of proposal forward to me, that's okay. Could you have two options like that?
Absolutely, Mike. So we often do run a dual track process, and that will involve considering a trade sale whilst also establishing what could be achieved via a management buyout. My only word of caution there is the conflict of interest, because on one hand, you might be saying to management, there's an open invite to buy this business, but we also, management, want you to sit with us and pitch the business to trade buyers. You can see there's a huge conflict. And managing that is incredibly important. The one thing that I see happen often, which is the one thing that erodes most value, is shareholders giving management team false hope that there's an MBO opportunity that's then taken away from them, because that only results in fallout.
Right. So really listening to you, to be honest, probably better to decide to go one route or the other would appear to be the best way forward.
I think the key thing to do is to make sure very early we actually establish as shareholders what we want from a transaction. And that will then probably dictate whether it should be single or dual track as a process, Mike.
Right.
Of course, not every business can be sold to a management team, because not every business has a management team who have the ability, the experience, nor the appetite to acquire the business that they are in.
Yeah, sure. Yeah. Okay, over to you then, Kirst.
Well, I mean, I have lots of questions, because although I'm obviously an expert on the subject, but yeah, I mean, we have had a very important comment, Mike, but it's for you. It's mentioning that rather.
Yes, Ed.
suave,
Yes, Ed. I've had a haircut. Yeah. Mrs. Ames, the dog clippers. One more time.
Yeah, like, I mean, he looks dapper. Do you not think dapper's the word? Yeah.
I had a different word, Kirsty.
Well, I mean, I use my word because I'm getting the money in the will, but you use your word. It's fine.
That's right. Sadly, I will not be a beneficiary, so I can speak my mind.
It's not true at all, Dad. Right. So, as we said, if you've got any questions, do send them through to Mike's email. But I have a question, which is, you mentioned a couple of times, is around the company size when you're doing the MBOs. Does a company size matter? Can you only do it if you have a certain amount of employees or a certain management structure? Like, how does it work on that?
Yeah, so the size of the business in reality does not matter. It could be a very small business. It could be a very large business. The one thing, though, that is very important to establish early is how the management team who are buying the business would fund the transaction.
Yes.
Because if, as an example, Kirsty, there was a management team of 4 who run a business, and that business is generating an EBITDA of £1 million, then of course that management team, if they were valuing the business they are buying at 5 times earnings, they'd be paying £5 million for that business. And of course, on the assumption that management team doesn't have £5 million under their mattress, they would have to establish how they could secure the funding they need to pay that £5 million to the seller.
Okay.
There are 2 ways in which a management buyout can typically be funded. The first is a debt-funded MBO, which would involve management going to clearing banks and debt funds to fund the transaction. The second is a private equity-backed MBO. In both of those options, however, because of the amount of leverage a business can typically secure, the vendor would definitely be expected to support management and indeed the transaction by deferring value, often either as deferred consideration or vendor loan notes. And that's because normally a debt fund or clearing bank would provide leverage of circa 2 to 3 times EBITDA, which for a £5 million purchase therefore means management could only actually secure third-party funding of circa 3 million, which means the 2 million gap would need to be funded by vendor loan notes. The reason I mentioned this, is because you ask size. Does size matter? Well, it does, because a subscale business, and by subscale I mean a business generating EBITDA of maybe less than £500,000, would often not attract appetite from funders.
Right.
And therefore, a lot of clearing banks, a lot of debt funds will not lend to a management team if they're looking to buy a business that generates EBITDA of 100,000, as an example.
Right.
So the only reason size matters is as a consequence of the funding options available, which are often only available to businesses generating EBITDA 500,000 plus. In a smaller business, Kirsty, an MBO is still possible, but what we would find is actually the vendor would have to defer more value for a longer period of time to help fund.
So if you, I have heard of an example where effectively someone had got 2 staff and he didn't want it. There was temptation just to close the business and turn it off, but he basically sold it to his people by taking the profits essentially for the following few years, and each time he took a chunk of profits, they got a chunk of shares. I don't know the technicalities of it, but that's kind of what I was told, and it took him 4 or 5 years to get his money out. I mean, is that a viable option if everybody is in agreement with that?
Absolutely, it is. So in a smaller business, Mike, that's probably the best way to structure a change of ownership with management, because it doesn't involve a third-party funder. because the vendor's funding the transaction to an extent.
Right.
The only thing I'd say that might, which is a nuance to the point you've raised there, is if I was advising on that type of transaction, what I'd probably say to the shareholder is that they should sell 100% of the business to management on day one, because that's the tax point, and that's when they lock capital gains tax rate, which is vitally important, because currently, if you sell a business, you'll pay £1 million of CGT at 10%. And the residual consideration after $1 million will be taxed at 20%. So if today you sell a business for 2 million, then your first $1 million will be taxed at 10%, the second $1 million taxed at 20%. However, Rishi Sunak has made it very clear that within the next year, capital gains tax will increase significantly, so that it's more in line with income tax rate. So first of all, you want to try and lock in the tax point now if you're the seller. What you could do is lock in the tax point now, sell the business, but receive over the next 5 years consideration, which could be linked to the performance of the business, like an earn-out structure.
Right. Okay. So basically, you pay your tax, and it's some sort of, as you say, deferred. Not even loan notes, is it? Really, it's just a deferred payment based upon the profits that come from the business.
That's exactly right. And, you know, we can be quite creative in how that is calculated, you know. So if the value of the business today is $1 million, we might find the shareholder only receives $500,000 on day one, and that could come from the business's balance sheet or free cash. The residual $500,000 could be paid out over a 5-year term, 100,000 per annum, assuming the business delivers EBITDA of 200,000, accepting that if EBITDA is north, the seller might see, you know, a pound for pound increase in the earn-out consideration they get.
So you could be quite creative with the exit in that respect, but still lock in the tax breaks and make it clean.
That's
essentially
that's the key point, Mike. So, you know, we all know that within the next sort of 6 to 18 months, capital gains tax is going up. We think entrepreneurs relief might be abolished, which could mean the main rate CGT goes from 20%, maybe as high as 35%. As the Chancellor tries and bridges the gap between CGT and income tax, which will have a huge impact on what you receive when you sell your privately owned business.
We got 10% on all of ours. Not that I'm making a big deal.
Well, I mean, look at that, Mike. I mean, you know, it's a really important point, because 3 years ago, each owner, each entrepreneur had £10 million of lifetime allowance, which meant their first 10 million of capital gain could be taxed at 10%. That's already been tapered back to 1 million. And of course, what comes next is the relief is removed.
Wow.
Okay. For sure.
With that shining moment, let's just move on a little bit. So let's say, you know, obviously time is a little bit of an impact here. So what sort of preparations do you need to make, and how soon before you want to sell do you have to start making them?
Yeah, good question, Kirsty. So first of all, you know, if you as a business owner really want to consider selling your business to management, then first of all, you need to make sure you have a management team who can be the recipient of the invite, because if you don't, then of course it's just a non-starter. I think secondly, I think what you have to do is to start bringing management into discussions about ownership, because respectfully, there is a big difference between an employee who does a very good job versus an individual who wants to acquire and take ownership of a business. You know, that's night and day different, right? So bringing people into discussions about your desire to sell your business early, I think is really important. But again, only do that if you think that management team potentially could be the acquirer. And if you conclude that management will never be the owner of the business, then that's fine, but still bring them into your discussion and make it clear that as a consequence of retirement planning, you know, you are thinking about positioning the business for sale. I think also if a management buyout is on the cards, then what we have to always remember, especially if we're going to have management fund the transaction via a third party, is that that management team will have to present to banks, to debt funds, and to private equity. So actually they have to be experienced. They have to know the business, not just the job they do in the business. And therefore bringing them into board discussions is really important. And the sooner those types of discussions start taking place, Kirsty, the better, because we have more time to prepare management and indeed the business for the transaction that follows.
So you're basically talking about So someone's sitting there with their business now, and maybe they don't have a management team in the sense of 4 or 5 managers that manage 100-person company, but maybe they've got like a senior guy or something, or a person who's doing a really good job, and then 3 or 4 people in the team. And so if they're thinking an MBO could be the only way that they could get money out of this business, because nobody would want to buy it if they'd gone. So they should really be having that conversation now to say, guys, look, I'm not going to work in this thing forever. One of my options when I leave is for you guys to take it off me. Who's up for that? I mean, is that the kind of conversation that we're having to begin with?
I think that's right. I think that's right. Is this a business that you, as a team of 1, 2, 4, would want to take ownership of? And of course, you very quickly, assess the temperature of the bathwater, and then you know what you're dealing with.
And if
flag there, my friend, excuse me. The key thing to flag, which is really important, is not only are you asking management whether they have the appetite, but actually you're also asking whether they have the desire to take the risk that one has to take to move into ownership. Because of course, unless this is going to be a vendor-funded MBO, the vendor receives the value from the business over a period of time based on the business's performance, then of course there'll be a third-party funder backing management. That funder will want management to have a degree of financial exposure, because they need to know management's feet to the fire. And therefore, will the management team have the ability, the appetite to cash contribute or provide an unsupported personal guarantee? And that's when very often, the appetite dwanes.
Yeah.
So they normally, do they normally, the third-party financiers, would they normally expect the management team to put a bit of skin in the game just to prove that they're serious about it?
That's right. So ordinarily, if there is a clearing bank, Barclays or HSBC, funding an MBO, Mike, they would expect management to contribute one-time salary. That can be in cash, or it can be an unsupported personal guarantee. But using your phrase, the bank will want to know management, who are getting 100% of the equity upside, have their feet to the fire.
Right. Okay. And so the difference then between, say, like a bank funding it, is they'll just lend the money, whereas with some kind of investor, they'll take some shares and give some money. That's the difference between the two. And both of those are a possibility, are they, for bigger businesses?
That's right, Mike. And I think you've highlighted there the difference. So typically private equity or a financial investor that takes shares will only want to invest in a business that is of a certain size, typically £1 million of EBITDA plus. And therefore, for smaller businesses, MBOs are typically funded by debt, whereby there is a loan repayment with an interest coupon. And in that type of instance, it's great because management get all of the equity, but that debt provider who wants their debt to be repaid with interest need to know that if the business has a difficult trading period, that the management team are going to dig deep rather than disappear to the hills. Hence why they need management to have skin in the game.
Yeah. Okay, that sounds pretty straightforward. Yeah.
I mean,
one point just to share there actually as well, which is interesting, is if you are an owner and you're looking at an MBO versus a trade sale, I think that with an MBO, not only do you have a ready-made buyer, because it's a buyer that exists in your business today, but also because they know the business, they'll be carrying out less diligence, which means, of course, there is less risk of the transaction falling over. Always a risk when you're selling to trade, because they're going to diligence the business to death. I think the other thing to just acknowledge is that when selling to management, because the management team know the business and run the business, the seller will often give fewer warranties to a management team. Whereas, as you know, Mike, when you sold your business to Harvey Nash, the warranties you are giving are very, very comprehensive.
They were, yes. They've all expired now. You can relax.
Well, that's right. We can breathe. But not only are the warranties very comprehensive and onerous, but of course, there is always a risk that the value you get, you don't keep. Whereas when selling to management, because the warranties are so limited, because management know the business they're buying, actually the vendor knows the value they get, they keep. That's a really important point to deliberate.
So if I'm getting this correctly, and I know we've got to wrap up fairly soon, so an MBO is actually an option for any size business, really. But for smaller businesses, less than an EBIT of 500K, really it's probably the only way that they can exit with a value, rather than just turning the lights off and closing the door behind them. And if they do that, whichever way they go, the sooner that they engage with their management team to say, this is what's involved, would you be interested, the better. Because if they're not, clearly that's not an option for them. They must consider something else. Would that be a fair summation of what we just kind of covered?
That's a great summary, Mike. I think the only thing I'd add is, before the shareholders do speak to management to assess whether management would have appetite, I would strongly encourage the shareholders to get in touch with myself or another corporate finance advisor who can actually talk to the shareholders about what's in the art of the possible and some of the detail that they need to be thinking about before deciding when and how best to engage management in that type of conversation.
Okay, I know Kirsty has her last, like, what's your piece of advice question, but before I do that, just on that very point, this, and again, you've got a vested interest in this, but just put that to one side. I know you're a professional person. It really is a good idea to bring in a professional person earlier rather than later, even while it's just I mean, you would perhaps speak to people even if they hadn't made up their absolute mind. You need to start to engage early, don't you?
Well, you do, Mike, because a lot of the things that one has to bear in mind not only is complex, but also any recommendations that would be made take time to bed in. So, the first question that any shareholder should be asking is, what is my business worth? What is the market value of my business? That's a question that I can answer. Once we know the value of the business, the next question is, who do we think would be the likely acquirer of my business? That's when we can start looking at trade. Are there viable trade acquirers in the market today who we think would be interested in acquiring the business? And is there a management team who could be potentially, therefore, a viable option in its own right, i.e. an MBO? We can then compare and contrast trade sale versus MBO, pros and cons from a valuation, from a deal structure, from a tax, from a legal risk perspective, i.e. warranties, indemnities, etc., before the shareholders then decide which of those two options is most attractive, accepting that both could be attractive and therefore dual track could be appropriate. Point is, having knowledge gives the shareholders the ability to make the right call.
Okay, yeah, thank you for that. Yeah, that makes sense.
Yes, it very much does. And I mean, I obviously knew a lot about MBOs before this little chat that we were having, but now I definitely feel like I know a lot more. So that's been very good for me. But what I will say is we like to give anything at the end of our shows. We like to give people tangible advice, things they can go away and sort of get their fingers stuck into. So somebody's been watching this and maybe they either hadn't been considering an MBO but now are, or they've been, chugging around in the back of their brain. So from you, what is one piece of advice you would give to somebody watching who's now thinking MBOs might be, what's the one thing that you would tell them to do?
The one thing I would tell them to consider, Kirsty, is not only whether there is a management team in the business who would have the appetite, but actually would they have the ability, and would they financially be willing to have a degree of financial exposure to pursue the ownership in said business, because appetite alone is not enough.
Right. Okay. I think that's
okay. And if somebody wanted to know a little bit more from you, what's the best way for them to reach out to you then, Carl?
Sure. So the best two ways, Mike, is people can either email me, contact me on LinkedIn, or call me on my cell. Delighted to speak to anyone at any time. Any questions worth asking for sure. And I think similarly, Mike, they can contact me through your very good self.
Of course, yes. Of course, if you email me, we'll pass on the details, Carl's details to you, so you can call him if you want to. So absolutely, yeah.
Perfect. Thank you so much to Carl today. It has been an amazing show. I've learned so much, and now I'm considering an MBO. I'm not even wanting to sell. I'm just considering it now. So thank you very much, Carl. What I will say is next week it's going to be just the two of us, Mike, I believe.
Yes, it is.
We're going to be chatting about USPs because, things are starting to hot up a bit now. Markets are going to get feisty, I feel. And so having strong USPs and a way to differentiate yourself amongst your competition is going to be real key. So we're going to be discussing that next week. So if there's no further ado, I'd like to say thank you to Carl again. Thank you so much for being here today.
Thank you, Carl.
Pleasure.
And thank you to Mike, who has already done a full work day and it's barely even lunchtime. So thank you to you, Mike.
And
It's
also due to you, Kirsty, you've been a phenomenal compare, and I've really,
no,
Thank you,
Carl,
Carl.
no.
Thank you, Carl. You can come every week, Carl.
Can I come
Thank you,
again?
Carl.
Can I come again?
I'm going to change that sign up there to say the Kirsty Ames Show, and you can come every week.
I think you
Why
should.
not? Why not go the whole hog and call it the Kirsty and Carl Show and be done with it?
What a great suggestion, Mike.
That's a
With that,
great
I think
plan.
we'll leave. We'll see you next time.